Sorry about that. Hans, I'm sure you can hear me now. Apologies, I was just doing that quick introduction. Okay. So look, what I was referring to just then, thanks for reminding me, by the way. I don't know why that's become a problem yesterday and today. We've only been doing these broadcasts for years now, so apologies. So we were just talking about yesterday's CPI figures. We saw eventually a bit of a move in the dollar as per expectation. Now we've got the second part of that. So we've got the PPI, see how the Fed react. And we've also got Jerome Powell. Be prepared for a bit of volatility as we close the European session. But it's largely due to Jerome Powell, which will be testifying today and tomorrow. So, and he's going to be grilled on the inflation expectations. I was just commenting on the fact that the expectations for CPI 0.5, 0.4, it puts the actual CPI data at nearly double that, and what that is doing is the Fed are looking at between 4 and 4.5% inflation over the course of year on year, and it looks like we're going to be seeing a considerable increase in that, somewhere up in the region of about 6%. So that's a significant uptick, and this is where the bond yields come in. This is why this is quite important. How are the bond yields reacting? And to keep this as straightforward as possible, these bond yields are not concerned about inflation. These inflation figures don't seem to be impacting. They seem to be erring on the side of the Fed that it's transitory. We're not going to see an uptick in inflation over a prolonged period of time. There's nothing to see here, and let's carry on with business, which is pushing stock prices higher. We're seeing this incredible bull run in these markets, and it's very much supported by the bond market as well. These bond yields are suppressed, giving obviously very little return. In fact, negative real yields are less than 0%, so we're in negative territory. And what it means for investors and traders is that you're better off looking for some yield elsewhere in terms of your stock market. So we're seeing an uptick in the stock markets as a result. And the other thing about the bond markets is that there's still incredible demand. So we've had slightly lower than expected 30-year bond yields. So the 10-year on Monday, we saw much lower rate, and we saw significant demand. If we look at yesterday's 30-year bond, much lower rate and lower demand as well, but the demand is still broadly really quite significant for rates. Tying up your capital for 30 years at these rates doesn't seem like the most intelligent, I suppose, in a normal run of things, to tie your money up for so long and getting very, very little, in fact, getting a negative return on that investment does seem sort of anti-market. But these are the conditions in which we're trading, where people would prefer to tie up capital for long periods and not make any money rather than expose it elsewhere. So it's just the nature of these markets at the moment. So we're looking across many of these markets at the moment, and we're just seeing sort of retracement territory. So that's in the build up to today's PPI. Anyone trading the Canadian dollar, just be mindful. You've got the BOC at 3 p.m. Crude oil inventories at 3:30. Expecting another negative figure, and this supply shock is likely to remain intact, where we're seeing where OPEC were unable to agree increasing supply. So there is this supply is very much suppressed, and demand is increasing. So it does lend itself to potentially a buying opportunity in crude oil. And we'll see how the market reacts to this event as well. It might give it an extra boost to the upside. We'll have the press conference at 4 p.m. and then at 5 p.m. we'll have the Fed Chair, Jerome Powell, due to testify as well. And he will be grilled on a whole range of factors, of course. But what will be quite interesting for the bond markets and the stock markets will be this inflation story, which is much higher than the Fed anticipated. They've already alluded to the fact that we'll see 2 rate increases between now and the end of 2023. So all of these things are creating, I suppose, an environment for stocks to continue to push higher until something changes. So that's the big question. Will the bond markets be the catalyst for the stock markets rolling over to the downside? So a big day for news, really, certainly in the afternoon, very much specific, like the Canadian dollar and crude oil inventories and the US dollar as well. So with all of this in mind, and bearing in mind that we're seeing these very, very low rates in the bond markets, what opportunities do we have? Let's see what opportunities we have for you. So if I can just bring up our trading platform. So the first observation is all we're really seeing today is a reversal on yesterday's move to the downside, and we're seeing that pretty much across the board. So we're in this market to the downside, and I suppose seeing a pullback in these markets is not such a massive problem, because we've got these levels of resistance, and what you want to do is at some point you want the sellers to actually regain control of the trade. So we know markets don't just move from high to low in one straight line, they pretty much do that. So you've got to be prepared for the pullback, and that's what this is. So it's just looking sort of a little bit on a slightly longer term basis. We're looking for the rollover trade to the downside, and clearly right now today is not that day. We're experiencing the pullback. It doesn't mean we need to sort of freak out or panic or anything. Our analysis is very much in line with some selling opportunities. So that's the only thing we're looking to do in this market, is look to sell it right now, unless something changes. But at the moment, nothing significant is changing. That could change pretty soon if we saw markets like the pound actually break above this level in here, the 39.08. That would signify, a potential change or shift in direction. We're not there yet, so we don't need to preempt that. And again, we're currently in the dollar yen trade. This is currently just a pullback, and what we're anticipating, or what we're looking to trade, is the next leg to the upside, and we're currently just experiencing a pullback, but really looking to trade that dollar strength, and we'll see if we get that follow through. Today so far we're not really getting that opportunity just yet. A lot of either indecision or a bit of dollar selling, a bit of a pullback on yesterday's trading. We can see that across the board for the dollar. Significant move really for the New Zealand dollar overnight. We're just inside this little zone here. So this market is very much in this little consolidation period. So what we can look at is a breakout to the upside, or more importantly, and something that would interest us a lot more, is a breakout to the downside. So, and in fact, look, we can extend that out to these levels as well. So we're still inside this little range. So that does imply actually a slightly higher level at which to get into this market, but definitely the lower trade is the dollar strength side of this market, which is, it's a bit counterintuitive because we do have stock markets pushing higher. So I suppose that needs to be taken into account, of course. But we still have the conditions for some dollar strength as things currently stand, and that very well may end pretty soon. The euro pound to the downside, we are seeing further moves lower. We're not seeing a significant range in these markets, but our bias has always been to the downside. We've just really hated the erratic nature of the move, which is very much choppy up and down. But now we are breaking to the downside. We've got strong support down here, so we'd expect this market down to 84.72. It's just, we're going to err on the side of, I suppose, caution really. It's just been a market that has not been that kind. So we're not really seeing the strength as such in the yen either. The dollar is clearly probably the weakest market now today. But how long will that be the case for as we go into PPI is the question. And the market is waiting patiently for to hear what Jerome Powell is likely to say on the inflation story. Will we see bond yields tick higher? Will we see the stock market selling off a bit? Will we see the dollar strengthen? These are all sort of very likely outcomes. Price action is not there just yet. So again, we might need to be a little bit patient. A buy trade in gold is probably the clearest, and it's also, keep an eye on gold, which is the title of this broadcast. So above that 1817 level, we do have an interesting opportunity to the upside on gold. So we'll come into that. We would like as well the crude oil to push higher above 74.90. It's high up here at 76.42. So it's only $1.50, but it's probably $1.50 that would be a decent trade. Okay, so the S&P yesterday, or last night should I say, we were looking at this market and its ability to roll over to the downside. But again, it's a market that defies any... It's just constantly grinding higher. The Nasdaq, yesterday we made all-time highs. We're interested to see if we would get a little bit of a rollover off the back of yesterday's inflation data, and the answer is no. Very close to all-time highs as well in the Dow Jones. So these basket of indices and stocks are driven by a relatively few number of tech firms that are driving this price higher. So they're performing really well as we come out of lockdown. So that we've got this very low bond yield environment. So there is this flight to risk, and the stock markets are seeing the greatest moves as a result. So we're in mildly risk on market conditions. It's looking like the Bitcoin is under a bit more pressure, but very little volatility in these candlesticks over the last apart from the odd few days here and there, perhaps over the last couple of months, relatively little volatility. So the major news, so in last night's trade plan, just to clarify, we were looking for some dollar continuation. We're clearly not seeing that. The euro pound to the downside, which is a viable trade, and we'll keep an eye on US oil. You see, with the oil markets, we probably don't want to get into this market. We might not even get the opportunity to get into it until we see the crude oil inventories in the US and the gold market to the upside. So if we take the low, we've got a low of 1804. We're looking to get in roughly around the 1821. And this is where the inflation story might play a bit of a part. Because buying gold is a hedge against inflation, and if inflation is ticking up in real terms, we might see some capital coming into gold. So that's really the major trade for the session, really. Now look what we've got. We've got a really strong explosive move there within the last sort of 10 minutes. Let me see, the last 5 minutes, I guess, 5 or 6 minutes. Yeah, so in the last 10 minutes, let me see, when did this move kick in? 2, 4, 6, it's sort of 8 minutes ago, and we're continuing to push higher. So really, what we can do with this trade is just look to get in on the pullback. We are very likely to get a pullback. Just taking this 1818 level. So the pullback would have been the first trade, perhaps. Sorry, the breakout above that 1818 would have been the first trade, but we're probably likely to get a bit of a pullback in this market, so that's what we can focus our attentions on. So what we would like to see is this market come back to a level of support and then take the next leg to the upside. So we're still looking to get in around sort of the 1820, something like that. So it's still that breakout trade above that 1817 level. We're actually seeing a significant reversal now on yesterday's dollar strength trades. So unfortunately, there's your breakout trade above the 1818, and you know we miss trades all the time. It's just not possible to cover every move when it happens, and you miss obviously the initial breakout trade, and that can happen from time to time. Every trader misses trades for a variety of different reasons. And what we used to use an awful lot was pending orders. So we could place a pending order in at sort of 18, 19, and you know be in this type of trade. But we haven't really used them certainly since COVID broke, because the erratic nature of some of these markets has been quite excessive. So you know, what we would see on a regular occasion would be, you know, these breakouts and then a really strong just rejection of the high, and then, you know, these prices ticking to the upside. So if we can see that live, we'd prefer to make decisions off that basis. So and we got PPI as well, and that's likely to impact this market. So, you know, yesterday we waited for a pullback in the euro dollar and the dollar yen, so we got decent entries because we were patient to wait for the pullback, and now we would need to do the same for gold. Otherwise you're getting in at 1824 and you're kind of leaving sort of $6-7 on the table, and if you're looking for a $15-20 return, then that's sizable. That's a sizable amount. So we're going to keep an eye on the S&P just to see if this price can get up to these levels, or will we get up that further rollover trade to the downside. Crude oil, we do want to see if this market can break above this level. So we'll just look at the gold market, crude oil, and the S&P just to kind of monitor these trades. And of course we'll look at the euro dollar. So we can see that the euro pound to the downside. So gold is ticking significantly higher. So in a market like this, we'd probably prefer a little bit of a pullback. I mean, we got a pullback, I think, during the Asian session to the 85.28. So that would very much be, you got your breakout trade, that would be a pullback trade. Now that prices are below, let's see if we can get in on a pullback. So yesterday we were looking to sell this market below the 1835. With the volatility, we were only able to get into it a little bit lower. It kept wanting us to reset the price before we got into the trade, and the prices just kept sort of flushing to the downside. So we trade a few markets and we were able to get into the other ones at a much better price, but not this particular account. So the euro dollar to the downside. We're seeing a strong retracement of these levels, of course, right now, which is fine. So we've got the breakout trade above that 1818 level, and now we want to see it come back and look to get in maybe around 1820, something like that. And if we do that, we can pull the trigger. We'll just keep an eye on this crude oil figure, and we'll keep an eye on the S&P. So these are the markets that we're looking at as we go into PPI data. And in fact, we probably want to refrain from getting into a gold buy trade because of this PPI data that's due out. And it's going to be interesting to see how the markets react to the inflation story. Maybe it may very well be quiet in the build up to Jerome Powell's testimony. We're getting pullbacks in the pullback trades in the euro dollar and the dollar yen, which we're looking at off screen, but we're still comfortable to be in those trades to the upside for the dollar yen and to the downside for the euro dollar. So we have got just over 10 minutes. I'm sure we'll get a little bit of an update. We'll get our Squawk service to just give us a little bit of an update in terms of the latest expectations and preparing ourselves for that news event, like we saw yesterday, of course. So what I might do is, if you could just give me a couple of minutes, perhaps, I'll be back to you very, very shortly. Yeah, we've got a bit of time now. Those are our trades currently up on screen.
10 minutes away now to the bottom of the hours with the US PPI numbers for June. The final demand month-on-month figure 0.6% expected versus par 0.8. A range seen, according to Reuters, of 0.3 to 0.9%. By the ex-food and energy reading for month-to-month PPI, 0.5% expected versus par 0.6. A range seen of a flat reading to 0.7%. Well, in the year-on-year figures for PPI, final demand 6.8% expected versus par of 6.6. A range seen of 6.5 to 7.2. Well, ex-food and energy year-on-year, that's a reading of 5.1 expected versus the prior 4.8. A range of 4.8 to 5.2% seen. Additionally, from Canada, we could do with the Canadian manufacturing sales numbers for May, month to month at 1.0% expected. That's versus par minus 2.1, range 0.5 to 1.5% seen.
Okay, so look, we'll come back to that in just a few minutes. So
notes here from TTS before the upcoming PPI data, and they know the reopening related surge in the PPI probably continued into June, as with the CPI strength in energy prices likely added to strength in core prices. Indeed, they look for a strong 0.7% month-to-month gain in the overall PPI, and also for a firm 0.6% increase in the core measures.
Okay, we'll do further analysis now in just a second. So if I can just, I'll just put up the screen for just 2 minutes while I just pop away, and I'll be back to you in 3 to 4 minutes, and then we'll prepare for this PPI news event. So I'll be back to you in just a moment.
Information on the EU's climate plans is set to tighten the carbon market 4.2% a year in the Green Deal push. 3 minutes away now to the release of the US PPI numbers for June, with final demand a month-to-month 0.6% expected, ex-food and energy month-to-month at 0.5%, and the year-on-year figures for final demand PPI 6.8 expected, with the ex-food and energy year-on-year 5.1%. Again, we wait the Canadian manufacturing sales as well in 3 minutes, with the May month-to-month reading 1.0% expected.
Okay, so sorry about that. Right. Okay, so we get a bit of an update on this PPI number now in just a minute. The dollar's quite weak. It's kind of quite supportive of the stock markets. With lower bond yields, it's encouraging prices to be pushing higher. We'll see if that's the case when we come out of this PPI number. Getting a strong little pullback in the euro pound. Not quite a pullback just yet. We're in the middle of a pullback in the gold trade, and we'll keep a close eye for the crude oil number just above that 74.98 level. So we're just a few seconds away then from this news event, and to just remind you, we are looking for 0.6 and 0.5. So we're looking for deviations of this number. So we'd expect probably a bit higher like we saw in the CPI, but we'll wait and see. So 0.6, 0.5, and we shall find out what that is now in just a couple of seconds. So what will be important to just see the reaction in the dollar. And the euro dollar is an interesting one, because the dollar index is 60% made up of the euro dollar, so it often works in tandem, and it's a good indicator.
FOREX Powell testimony released here as well, as we await, saying that the Fed is to continue bob buying debate in the coming meetings, reaching substantial further progress a ways off. Looking to the data release, PPI final demand month-to-month at 1%, ex-food and energy month-to-month at 1.0%, year-on-year at 7.3%, ex-food and energy year-on-year at 5.6%. To get a break, that's Fed's Powell's testimony released here, with the Fed to continue bond buying debate in the coming meetings, reaching substantial further progress a ways off.
Okay, it seems like these PPI numbers are much higher as well.
Full comments noting that monetary policy will deliver powerful support until recovery is complete, and job market still ways off from progress needed to begin the bond buying taper. Inflation likely to remain elevated in the coming months before easing, and expectations broadly consistent with the Fed target. Household and business balance sheets quite strong, while core financial institutions are resilient. Strong job gains are expected to continue in the coming months as health crisis continues easing, household spending rising at a rapid pace, and household demand strong and business investment is solid. It's a quick recap as well of the US data's PPI final demand month-to-month coming in at 1.0%, hotter than the 0.6% expected, with ex-food and energy month-to-month at 1.0% as well. The year-on-year final demand PPI reading coming in at 7.3%, and ex-food and energy year-on-year at 5.6%. From Canada, the manufacturing sales numbers month-to-month at minus 0.6%, as well by the 1.0% expected.
Okay, so PPI is hotter than expected, and the problem with higher inflation is that the central bank can use monetary policy measures like increasing interest rates and tapering their bond buying program to take some heat out of the economy and inflation's ticking higher, and they're reluctant to go along with that sort of general analysis by the looks of it. And what we're seeing initially off the back of the news event, maybe it's taken a bit of time to digest it, but there's grounds for the dollar to strengthen off the back of this news event, and it's not doing so. There's also grounds for the S&P to roll over to the downside, and it's not doing so. Gold, we'd like a bit of a pullback. If we can get in on a pullback in gold, it would probably be a very decent trade. So it might just be the gold market that we can keep an eye out for. Okay, I wonder what that core PPI figure is. I don't think I've heard it through the channels. And so what's clouding the water slightly is so the FOMC is to continue bond buying debate in the coming meetings. So it sounds like it's going to be they won't be making any rash decisions anyway. The core PPI is double the expected as well. These are very significant inflation numbers, and the Fed are happy to tell us, these are much higher numbers. Let's see how far back we'd have to go with the PPI. Okay, we'd have to go back to sort of 2012, where the economy was running quite hot, and 2011, and obviously during the financial crisis as well. But we've not exceeded these levels now for 7 years, as you can see, and we're doing this consistently now.
We are seeing S&P futures hitting their session highs. Just repeat some of the main comments as they note they're reaching substantial further progress away, so often Fed to continue bond buying debates in the coming meetings. Well, emerging market research news here as PwC note that South Africa unrest may shave 0.4 percentage points of their 2021 GDP growth.
Okay, so we're just gonna off the back of this news and the price action that we're seeing, we're going to bring our stop loss up to a low of 110.20, so 110.16. So we're going to mitigate risk on that trade. If prices, if we make a new high and we roll over and we start breaking below the daily low, then this is not a trade that we don't really want to be in. So leaving our stop loss where it was just leaving that extra cash on the table, and there's just no need for us to do that. We do want to see a constructive pullback if we can in gold before we get into the upside. We can leave. Unfortunately, our stop loss is at a level which is an intraday high. It's not a daily high or anything, but this market has to work quite hard to break above these 2 daily highs in here before it takes us out of the trade. So we can leave our euro dollar sell trade, but we'll certainly want to mitigate risk on that trade. Okay, so we've moved our stop loss up a little bit, and it looks like it's going to flush through it to the downside.
Heads up here, in just under 10 minutes time we are waiting comments from ECB Schnabel, set to be delivering a speech at the Peterson's Institute Financial Statements webinar series, Challenges of the Low Interest Rate Era. The text is expected to be released on the ECB's website in just under 10 minutes time at 1:45.
Okay, so just to sum up, and I'll let you guys go now. We do have another trading session to move to. So what we're seeing is really strong inflation data. We're seeing a counterintuitive response from the dollar and the S&P. We're seeing the right type of move in gold, which is why we're looking to buy this market. But the stock market's pushing higher, and the dollar weakening in a sort of with such an uptick in inflation is a bit counterintuitive for us. It doesn't really make too much sense. It's only likely to bring forward rate increases and bring forward bond buying tapering as well. So all of these things formulate to the dollar strengthening and the stock markets rolling over. So we're seeing some counterintuitive price action. It's the market's prerogative to move in any direction which way it wants to, but we just need things to fit for our own benefit in order to get in. So just to clarify on our we're looking for the dollar yen to actually roll back over to the downside, and the euro dollar to actually take its next leg to the downside as well. That trade would make sense and would be worth trading. The S&P we can back off. I don't think we'll get anything in crude oil until we get the crude oil inventories at 330, and we just want to wait for a pullback in gold. So that's kind of our analysis. It's a bit wishy-washy. It's not great. It's not that coherent, to be fair. But we've got to trade the conditions that we get. So look, on that note, guys, thank you very much for joining us as always. We will be back tomorrow around 12:30, so if you could join us for that, you're very welcome to do so. So from everyone here at the Live Trade Room, take care, and we'll speak to you soon. Bye for now.